Hello everyone, good morning. Today we are here to discuss on chapter 2 of class 11 accountancy. So we have already started with chapter 2 theory basis of accounting in our last lesson, and in that particular lesson we have studied about accounting concept and convention, definition of accounting concepts, definition of accounting conventions. We have also studied what are the various types of accounting concepts available, what are the accounting conventions that a business organization must follow to prepare the financial statements of the business organization. And as discussed earlier, that this chapter will be divided into two parts. In our last lesson we have discussed about the first part of chapter 2, that is theory basis of accounting, which contained the following topics of accounting conventions and accounting concepts. In today's part we will learn about the basis of accounting, about the systems of accounting, and following the systems of accounting, what are the rules of recording the transaction. So let's follow the video. In our last lesson, we have studied about theory basis of accounting part 1, and this lesson belongs to part 2. Here we will learn about basis of accounting, system of accounting, and rules of debit and credit, as we have learned in the last lesson about accounting concepts and conventions. See, the main objective of accounting is to calculate profit or loss of the business, and this accounting can be classified into two bases, that is cash basis of accounting and accrual basis of accounting. To start with actual basis of accounting, we can discuss that incomes are recorded only when they are earned or accrued, irrespective of the fact whether cash is received or not. So we can say that if sales are made on credit, that is money is not received, it will be included in the sales calculation for the accounting period. And next we will discuss about the cash basis of accounting. In cash basis of accounting, what happens is that revenue or income is only recognized after receiving the cash, and expenses are recorded only when cash is paid. So we can say that credit transactions, that is if we have made any expenses but money not paid, are not recorded. Next, we can see some differences between cash basis accounting and accrual basis accounting. The basis of difference are mentioned as meaning, object, process of recording, financial statement, recognition, business transaction, accuracy level of business. Now, if we go to classify the meaning, in cash basis accounting, we shall record the transactions only when cash is received, and in accrual basis accounting, we will record the transactions when they are actually made. The main motive of cash basis accounting is to calculate the cash balance of the business, and the main motive of accrual basis accounting is to calculate the profit or loss of the business in a particular accounting period. Cash basis is quite simple, accrual basis is a quite complex one than the cash basis. Next, we can say that the financial position does not show the actual financial position in case of cash basis of accounting. But for accrual basis of accounting, we get a true picture of the financial position on the basis of accrual basis of accounting. Next, we can say that cash basis is not recognized by GAAP and accrual basis is recognized by the law or generally accepted accounting principle. Under cash basis, we can say that only cash transactions are recorded, and under accrual basis, both cash and credit transactions are recorded. Cash basis is less accurate system of accounting, and accrual basis is the actual accurate system of accounting as compared to cash basis. Cash basis is for small business and accrual basis goes for large level of business. To discuss about the systems of accounting, we can classify that there are two systems of accounting: single entry system of accounting and double entry system of accounting. And we will discuss about the single entry system in brief and double entry system in details. The single entry system of accounting have a separate chapter, and double entry system of accounting forms the rules of debit and credit, which will be helpful in recording the transactions in chapter number 3. So we can discuss about single entry system of accounting, that this accounting system records only one aspect of the accounting. See, while discussing about various accounting concepts and conventions, we have learnt about dual concept of accounting system. That means for each transactions, two way of recording is maintained: one, what is coming in, and what is going out. But in single entry system of accounting, this records only one aspect. In some cases it does not record any of the item, and in some cases it records both the aspect. So that is why we can say that single entry system of accounting is basically a very unscientific system of accounting, because it does not follow a particular system, or particular comparability is not available from this system of accounting. And example is given over here, you can look into it. Now to discuss about double entry system of accounting, we can say that it arises from the dual aspect accounting concept, where it has been said that for every transaction two ways have to be recorded. One affects the receiving aspect and the another affects the outgoing aspect. That means two accounts must be affected. One will be the debit one, the another will be the credit one. As discussed, that double entry system follows the recording of two aspects of a transaction. So we can say that debit must be equal to the credit amount. Let's understand this with the help of an example. As per the example, we can see that furniture purchased is rupees 10,000. That means furniture is increasing, we can debit it, and for payment of cash, cash is decreased, we can credit it. Now, this payment or receiving of or increasing or decreasing of the items in a business depends on certain rules that we will follow. The rules on which debit account and credit account is decided are known as golden rules of accounting. Before discussing about the golden rules, we must discuss that there are three types of accounts. Number one is personal accounts. Now, personal accounts relate to any individual, any person, any firm. It can be a company, it can be an institution, etc., etc. So, they can be a person if a person is buying goods known as debtor and not paying the money, and if a person is selling goods and not receiving the money is known as a creditor. All this you have learned in the basic terms of accounting. Now coming up to the rule, it says debit the receiver, whoever receives will be debited, whoever gives is be credited. Now as we were discussing, personal accounts can be human beings, that is persons, it can be companies, it can be institution. Let's find it out. Here are the types. Number 1, natural person, number 2, artificial person, and number 3, representative personal account. Number 1, being a natural person can be known as normal human beings. Artificial persons can be banks, financial institutions, company, etc., etc. Now the most important is representative personal accounts. What are they? Basically, we can say that whenever there is an income or there is an expense, and if there is any suffix or prefix to the income and expense, it is treated as representative personal account. Examples can be outstanding expenses, prepaid rent, accrued income, etc., etc. See, these outstanding, prepaid, accrued, etc., etc. are the suffix or prefix. Next account that is to discuss is real accounts. They have physical existence, they are seen, they are felt, they are touched, and somewhat if we can say that there is an exception, that is they can be intangible also, but has definitely an effect on business organization. The rule of real account is debit what comes in and credit what goes out. That means whatever is increased in the business organization will be debited, whatever is reduced from the business organization will be credited. The third and last type of account is nominal account. Basically, they affect the business organization. The result of these activities can be seen, but they do not have any physical existence. Yes, they are basically business activities. They can be income, expenses, losses, gains, revenue, etc., etc. So the rule states debit all expenses and losses, credit all income and gains. So still now, whatever the rules we have studied is based on the traditional method. Now let's look into the modern rules of accounting. According to these modern rules, basically there are 5 categories. They are known as capital, assets, liability, expense, income. So what will be their effect? Let's follow. The first category is capital. Now to mention, drawings also fall under this category. So basically this relates with the proprietor's transactions, and the rule is debit when decrease and credit when increase. The next is asset. Increase is debit and decrease is credit. Next, what we can classify is as liability. For liability, it means debt. That means debit when decrease, credit when increase. Expenses, payment of money, credit when decrease, debit when increase. And last is income, debit when increase and credit when decrease. So you can follow the picture and note down the rules. These are the very important, or we can say the golden rules of accounting. So these are required to be noted down. So almost we came at the end of chapter number 2. From the next chapter we will follow recording of transactions, and this is the chart which shows that in where we will record what type of